Hey everybody, this is Ryan Mallory with SharePointer.com. Today I want to talk to you about shooting star candlestick patterns and their implications to trading and how we manage the risk on a trade. So, perfect example of this is with HES, that's Hess Corp. It's an energy stock. I traded it recently here and it formed a candlestick pattern. Now, originally, the reason for me getting into it was this very bull flag like pattern. So I'll draw it out for you. And here you go. You have a very nice bull flag pattern. It confirms it the day before, breaks out, and everything looks good. Now, this day here that we're talking about, we have a huge day to start with. The stock goes well over $60, almost hit 61. Everything looks fine and dandy. And then all of a sudden, because the news of the day was the Iranian deal with the United States, with Donald Trump pulling out of it, he had sent out a tweet that day that said that I'll be making an announcement in regards to the Iran deal. As a result, all the energy stocks started selling off right away, and HES was not immune to that. So HES, it pulled back quite a bit, going from around the highs of 60, 61 or so, all the way back down to 59.22 to close the day. So with about 15 minutes left in the trading session, I was left with a very interesting question. Do I hold this overnight and risk the additional gains? Because at one point I was up about 4.5%, 5% on the trade. At this point, I'm only up about 2% on the trade. So with the energy stocks, you do have to give it a little bit of wiggle room. I hate giving up a majority of my profits, but I don't think that the trade had reached a point to where I could tighten it anymore without just putting a stop loss in a place where it didn't really belong. And so I had my stop loss, riding up this 20-day moving average, but we had already, and I had made that change earlier in the day before it really made this big move higher. And so at this point, we're hitting 60, 61, and I haven't raised my stop loss yet. But then when we start seeing the sell-off take place, I have to make a decision. Do I risk getting stopped out the next day because there's not a lot of room between the current stop loss of 57.57 and where it's closing at? It could easily gap down. There's a lot of negative news going overnight. So what do I do? Do I hold on or not? And I went ahead and decided to close the trade because shooting star patterns are not the most bullish of patterns. In fact, they're very bearish. And what makes them a shooting star is when you have a small body and you have this shadow above the real body of the candlestick that's at least twice as big as the real body itself. And the real body is the body or the space between the opening price and the closing price. And so in this case, it is much more than 2x. It's probably more like 7 or 8x the real body. So we have a very legitimate shooting star pattern. And the other thing is it takes place in an uptrend. So we're in a breakout here out of the bull flag pattern, and then we get this possible head fake. And it also happened too when we were breaking above the highs of April. So we have a higher high being put in place, but then a shooting star as a result. So none of that was really boding well for me. Now, you have to also remember too, is when you're making decisions based off of candlesticks, you're making it off of probabilities that, okay, that's a bearish pattern that has a probable outcome of being negative the following day or the days to come. So you go ahead and book gains. It doesn't mean that it's going to be. It could easily rally the next day. But you can also go back and look at past history, and that's also something that I'd like to do. I like to see what kind of bearish shooting star patterns have there been in the past that the stock has violently reacted to. Now, good one right here. Back in October 2017, we're starting to move higher a little bit, and we get one there. You can see the days that followed were very bearish. 6 out of the next 7 days were very heavy to the downside. So that's one sign there that might mean that the stock isn't likely to do very well. We have another one here, but because there's such a large lower shadow, I don't take that one too serious, and it continues to go higher. Now, if the shooting star that I had when I closed out HES here, this one right here, if it would have looked like that one, I would not have had a problem This one right here, I would not have had a problem holding on to that another day because it was more of a doji pattern and not a shooting star pattern. But you can see there's other instances where we get these candle patterns that suggest that there's more downside ahead. Here's another good example of one right here. You can see 5 straight days of lower prices. And it's not foolproof. It doesn't happen every time, but there was enough instances where maybe you realize, okay, maybe I should probably get out of this trade and take the 2% that we have in it. Because as you can see, the next day, the announcement on the Iran deal came out, so there was a heavy news influence, and it pushed it much higher here. I mean, it went up almost 3% the following day. Yes, I get that those were gains that I missed out on, but when you manage the trade and you manage the risk, yes, there's going to be times where it rallies without you, and there's going to be times where you miss out on a big sell-off and you save a lot of profits otherwise. So this is a case where it did rally without me, but it wasn't an easy day of trading for it. I mean, you could see where there was a good likelihood I would have raised my stop loss even more today, and probably around the 5-day moving average, I would have raised it up to, so that would have stopped me out. But it would have been a frustrating trade because I would have been stopped out, and then the thing would have gone back up to almost its highs from the day before. So the stock, it's not a guarantee that just because it has a shooting star that it's going to go lower. What you're trying to do is take the information that you have on hand and try to make the best decision. And sometimes that might mean that you get out of a stock because it has a bearish candle, but the next day it rallies. That's okay, because what you're doing is over a period of time, over many hundreds of trades and over a lifetime of trading, you're trying to make consistently good decisions about the charts and about the risk management side of the trade. And that might mean missing out on some profits, and that's okay. But you want to have a history of just making good risk management decisions. And that's what we did here. And I don't think that that's a bad thing that it went up the next day. Is it unfortunate? Yeah. Anytime that I'm not in a trade that I could have made some additional money in, that stinks. But it's part of trading. Trading is not a perfect science. You're going off of probabilities.